It was the best of times. It was the worst of times.
And so begins Charles Dickens' A Tale of Two Cities. Halfway through 2018, you might say we're experiencing a tale of two financial markets. While traces of last year's optimism remain, fear and nervousness have also taken hold, spawning record volatility. The question becomes, will the best or the worst of times win out as the second half of the year gets underway? It's time once again to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategy strives to set new standards and bring institutional style investing to your portfolio. Hi, I'm David Scranton. Impossible as it seems, we're now more than halfway through 2018. And you know, a year ago, the financial markets were ruled by steadiness and hope, with Wall Street laser focused on the economic promise of Donald Trump's big corporate tax cuts. And so far this year, that hope has given way to uncertainty, even though the Republican tax plan was approved late last year. So what's been driving all this uncertainty? And halfway through the year, are we better able to forecast how it's all going to play out? Those are indeed crucial questions for investors in the income generation, and we're going to explore them today with the help of our guests, founder and CEO of Landmark Capital, David Fischer, as well as Tim Graham, the Director of Media Analysis at the Media Research Center. But first, let's examine the dramatic turn the markets have taken during the first half of 2018 compared to 2017. Yes, 2017, a year to remember. But just how different was last year compared to this year in terms of the stock market? Well, one way to gauge the differences is to consider the VIX, which measures volatility. The volatility was historically low in 2017, especially here in the United States. The S&P 500 actually avoided, throughout all of 2017, a 3% drawdown at any time during last year, and this is for the first time since 1995. The VIX actually hit an all-time low of 8.54 in November and never once spiked above its long-term average of 19.4. Globally, equity markets were similarly calm, with far lower than normal levels of volatility. Now, was all that calmness a reflection of a booming economy and the fact that all was calm and quiet in the geopolitical realm? Well, obviously, not so much. Regardless of how you feel about President Trump, there's simply no denying his first full year in office was a tumultuous one. Partisan battles over immigration, healthcare reform, as well as his economic and foreign policies. These types of battles raged constantly, and most of them continue to this day. Add to that all the saber rattling between the president and North Korean President Kim Jong-un, looming concerns about trade policies, constant personnel turnover in his administration, major domestic protests on a number of issues, and let's just say that if there were an index to measure social and political volatility, it would definitely have not hit any historic lows in 2017. In fact, quite to the contrary. So, how was Wall Street able to shrug off all that turmoil and keep the markets not only stable but climbing fairly steadily throughout last year? Well, as we pointed out before, it was focused on the hope that President Trump would win approval for his tax plan. With its massive cut to corporate taxes and vow to put extra spending money into the pockets of all consumers, Wall Street was banking on the plan being able to deliver the 4% GDP growth that the president promised on the campaign trail. And by staying laser focused on that promise, big investors were able to ignore all the geopolitical uncertainties unfolding, and the markets marched onward and upward, seemingly without a care in the world. It helped, yes, that the economic momentum that has been slowly building since the 2009 recession ramped up a bit last year, and that economic indicators such as job growth and housing moved in the right direction. As a result, the Fed made good on its promise to implement 3 short-term interest rates increases in 2017, although all were very, very modest. And current Fed's funds rates are still just about 2% as of today. Why? Because other economic indicators were more ominous and ran counter to all of Wall Street's optimism. Inflation, for instance, remained below the Fed's target of 2%, and long-term interest rates remain low enough to keep alive the threat of a flat yield curve. What's more, real GDP growth for the year was, according to the Bureau of Economic Analysis, only 2.3%. Despite all this mixed bag and all the geopolitical uncertainty, the stock market stayed calm and ultimately grew by about 20% in 2017. Then, following the approval of the president's tax plan just before the holidays, the market added about another 6% just January of this year. And then, yes, came February 5th, Groundhog Day. That's when things took a dramatic turn, possibly signaling that the best of times were over. And here we are today, 5 months later, and that possibility remains as strong as ever. And the markets no longer seem able to shrug off geopolitical threats by focusing strictly on economic hope. And even those hopes aren't as bright as they were a year ago, particularly in light of one geopolitical threat that is increasingly becoming a reality. I'm talking, of course, about this possibility of a trade war. And we'll talk a lot more about it and what it can mean for the financial markets in the second half of the year, coming up in just a bit. David Fischer is a nationally recognized expert on the financial markets who appears weekly on several syndicated radio programs, including those hosted by Kevin McCullough, Steve Noble, and Joe Messina. He frequently shares his market knowledge and insight of the Federal Reserve at various speaking engagements and investment conferences across the country. David is also a precious metals expert and a regular contributor for the TD Ameritrade on Their Futures program, hosted by Ben Lichtenstein. David, welcome to the show.
David, thank you for having me on your show this weekend.
Of course. You know, it's funny because, gosh, what a difference 2 years makes, huh? Last year at this time, the markets were just moving forward. We didn't even have a 3% pullback in all of 2017, and we've had several of those so far this year. What's creating the difference from 17 to 18, in your opinion?
Well, I think it's 3 major factors, David. I think the Fed has a lot to do with it, unwinding their balance sheet. Obviously, the biggest thing that's in the news, though, is tariffs and the effects of that on the what's going to happen next mode. But also, this is affecting human behavior on the flow of money, domestic money and foreign money coming into the markets for supporting the capital markets. So those are the 3 main factors. Then there's a big disconnect kind of in reference to the market and the economy. Usually they kind of go hand in hand. We've had excellent, unemployment at 3.8%. The new June report came out for jobs at 177,000 new jobs added, although it was 185,000. They thought still great number. But the economy is dictated on what the market is doing. And so there's this kind of push me, pull you going on with the rhetoric, also with President Trump and the Chinese prime minister. What will happen next? It's just kind of like the first movie of the Dr. Dolittle, being that we never heard of, the push me, pull you. And that's kind of affecting this whole environment. Who knows what might happen yet?
So let's talk about that. Let's take those one at a time. And I just assume start with the Federal Reserve, if that's okay with you.
Sure.
My concern all along has been that long-term interest rates simply cannot go up very much given what's happening abroad. There's still some easing in various parts of the world that are acting kind of sort of as a governor on our long-term rates. And right now, the difference between a 2-year Treasury and a 30-year Treasury is only about 40 basis points. So how is the Federal Reserve going to raise the short-term end of the yield curve without creating a flat yield or an inverted yield curve? I mean, how is this going to work out?
Well, they might actually do what you're thinking that they might not do. I don't know that for sure. But Jay Powell is a quite different Fed chairman than Yellen and Ben Bernanke. He's data-driven, not market-sensitive, so much to speak. But the Fed is doing a couple things. Obviously, they're raising rates and trying to get to what you call normalized rates, but they're also unwinding their balance sheet, which is selling treasuries and mortgage-backed securities. To put it into perspective, in 2008, they bought these assets and used them as money to inject capital in the markets, and they did this at zero interest rate policy called ZIRP. And so they really artificially moving the market on injection of capital. That has come to a halt. They're pulling away the punch bowl, and now the market's kind of trying to stand on its own 2 feet. And by the way, the Fed in 2013 did series of modeling on computerized data to see what the effects would be by them raising rates and pulling away the punch bowl. In other words, taking away and unwinding the balance sheet. And every model they came up with, David, said this is going to cause market turmoil. So if you look at that, when we went in January of this year, when they sold the treasuries, which happens on the 15th and at the end of the month, on February 1st, we had huge 1,100-point drop in the market. It wasn't because of tariffs at that point, because those really weren't even being put into effect till March. So the pulling away of the punch bowl is a graduated thing, and the Fed by the end of fourth quarter will be at $50 billion a month of retracting treasuries and mortgage-backed securities. While this has happened, though, the European Monetary Union, the Bank of Japan, has been injecting money, about $150 billion into the market.
They're still easing, so they're not helping us out very much, are they?
No, not at all. But their program, they're starting to shrink down. When we get to the fourth quarter, they'll have stopped their injection of capital. And 2019 December, they're going to start raising rates. So they're going to follow. They're about 2 years behind what the Fed is, in essence. So when this happens, we're going to have a negative influx of money globally. That's not going to be good on global markets. That's why a lot of people are calling for a recession in 2019, maybe in 2020.
So, David, do you think that's going to fix the problem then? Do you think that when Japan makes a change and maybe some others follow suit, that will allow our long-term interest rates to come up to keep a yield curve that's not completely flat?
I think we're going to have the 10-year above 3, maybe 3.5 by the end of the year or first quarter of next year. Jeffrey Gundlach, who's one of the bond kings, has been saying this for quite some time. He's a little bit early on his predictions. He thought it would happen by now at 3%. Obviously, we would drop back to the 2.83 level. So who knows what we're going to happen? I don't think historically, when the Fed unwinds the balance sheet, and they've done this before, not at this level, though, 9 out of 10 times it's cause a recession.
Exactly, and that's what we're afraid of moving forward. Listen, Dave, I want to talk to you about that a little bit more in just a moment. We need to take a commercial break right now, and we want you to stay with us also. We have more words of wisdom here from my new friend on the income generation. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.
Dow suffers its worst single-day point fall, some 1,179 points. It's the largest single-day points fall in history, but we have to keep that into context.
And so it began. The Dow's plunge on February 5th was followed by a week of big losses, and within a few days, the stock market overall would be down by over 10%, officially putting it into correction territory. Now, although it regained some of those losses, the norm ever since February 5th has been big drops followed by cautious partial rebounds. Originally, it seemed that Wall Street's main worries were about rising interest rates and inflation. Then there were big fluctuations based on more tough talk between President Trump and Kim Jong-un, and based on concerns about Trump pulling out of the Iran nuclear deal, which ultimately we did. However, the worry that has gripped the markets most consistently recently at least, is the growing threat of an all-out trade war as the president seeks to balance what most economists agree are unfair tariff schedules, particularly with China, but also with other countries and the European Union. Those worries ramped up as June came to a close, with the Dow tumbling 402 points, or 1.6% on June 25th, after posting a 2% decline the week before. That was its biggest weekly decline since late March. The S&P 500 also fell 1.7%, while the Nasdaq dropped 2.4%. The pullback came after a relatively long stretch of gains, continuing the cycle of dramatic ups and downs that was kicked off, as I said before, in February. Compared to last year, when the VIX, or Volatility Index, was historically calm, in the first half of 2018, it's been historically active. By mid-April, the S&P 500 had already moved up or down at least 1% 28 times, compared to just 8 such swings for all of 2017. And the Dow and Nasdaq had been equally volatile. The latest big sell-off in late June was blamed mainly on a tweet by the president in which he called on trading partners to, quote, remove their trade barriers and tariffs or be met with more reciprocity by the U.S. Days before the tweet, the EU began implementing tariffs on $3.2 billion of U.S. imports. The president responded by threatening 20% tariffs on European cars that come into the United States. Now, keep in mind that when we last talked about the trade war threat on this show in April, it was at that time just that, a speculative threat. But as I also pointed out at that time, that really didn't matter where the markets were concerned. Why? Because if enough people were only worried about the impact of a trade war or any similar threat, then it has a real impact on markets whether the actual war ever takes place or not. Remember, the markets are forward-looking and driven by emotion, the two emotions being namely fear and greed. They anticipate optimistically or fearfully more than they react. But in this case, the thing they've anticipated fearfully is now showing signs of becoming a reality. On the heels of what the president tweeted just a few weeks ago, Harley-Davidson announced it would move productions of its motorcycles shipped to the EU overseas, based on the fact that new EU tariffs would cost the company $90 to $100 million a year. As a result, Harley-Davidson shares tumbled by 6%. Now, naturally, the company's announcement ramped up worries that the escalating trade threats could lead to similar moves by other U.S. companies. If that were to happen, it would further undercut the prospect of that 4% economic growth that Wall Street was so incredibly optimistic about a year ago. As analyst Brian Nick correctly put it, with the anecdotal evidence around Harley-Davidson, the concern is that what had been an escalation of rhetoric is leading to real-world consequences. So, where exactly will those consequences lead the markets and the economy as the second half of the year unfolds? And what will it mean for everyday investors with a significant portion of their savings tied to the stock market, and particularly to those who are members of the income generation within 10 years of retirement or already retired? We'll be back to talk about that in just a few minutes. And we're back here with our new friend, David Fischer. David, right before the break, you were telling us a little bit about your concerns about recession, and that whenever the Fed tries to take moves like this to raise rates, inevitably causes a recession. So you don't think it's going to be any different this time from the sounds of it?
I don't think we're going to be in a recession that's severe. I think we're going to be in a moderate one, but I don't think it's going to happen in the short term here. The economy is so strong, and I think we're facing not a financial crisis. We're facing the Fed pulling away the unwinding of the balance sheet. While that's happening, a lot of uncertainties with tariffs that's compounding the issues of people what to do with their money. And should manufacturers expand right now in this great booming economic cycle of businesses being able to grow with lower tax rate? So it's causing confusion. Once we get past the tariff, I think we're only going to deal with the Fed unwinding the balance sheet. And that's a beast that's unknown because how large the balance sheet is at $4.5 trillion. And it was pre-2008 about $880 billion. So we're going back to normalization. What is that? $1 trillion, somewhere around there is what projections are. That's a big sell-off, so we don't know what the effect that will be. Some say it could be catastrophic, like Jim Rogers. He's calling for the biggest recession we've ever had in our lifetime. So I don't know if I'd hold that sentiment, though.
So now how about demographics? You know, you mentioned Japan earlier, and one of the things that's kept Japan's interest rates lower over the last 20 or 30 years has been their demographic trends, aging population, which we are now having as this big generation, of which I'm a member, the baby boomers, is starting to spend less, starting to save more and pay off debt. You know, are we ever going to be able to see a 10-year at 4.5 or 5 again? Or is that demographic trend, people looking for fixed income, going to change and keep a long-term governor, if you will, on our long-term interest rates?
You know, things are quite different in this decade compared to even 15, 20 years ago.
Sure.
Obviously, in many aspects, we have cryptocurrencies, which was never thought about here just 4 or 5 years ago on a standard main environment where we could invest in. I'm not supporting cryptocurrencies, but as technology changes, the environment's going to change, and to invest in this decade compared to how it was pre 9/11 is just absurd. So who knows? Japan might be the new model, David. I would hope not, but you know, because we don't want to live on fumes and be in a recession for, you know, they've been in recession in essence for 18 years. So it's not a good economic model to go by. We're going to lead the charge. I still believe America is the greatest nation on earth. We're just hitting some speed bumps. We can't get out of the parking lot right now onto the superhighway because there's so much massive uncertainty. I say we're going to get to higher rates because when you look at the Fed, 1/4 point is an artificially low rate that we had for 7 years, and the high rate of 20% is totally ballooned from inflation in the 70s, early 80s. The normalized rate by the Fed should be about 5.3% when you amortize it over that period of time. The Fed is targeting 3.5 to maybe 4.5%. I think they're going to hit their target, and I think that's going to cause an inversion of the yield curve, and I think that's going to be our normalized rate. But I think things will adjust accordingly.
That's probably what's going to cause the next recession is the inverted yield curve. Absolutely. Yeah. David, can you stay with us for one more block? I know you've teased me a little bit about the trade war, so I do want to talk to you about it. I want to have you back. So stay with us. And you stay with us, too. We have more words of wisdom from David Fischer. We'll talk about the trade war and how it may or may not affect the markets. We'll be right back. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday. So with 2 fiscal quarters of the year now past, the question becomes what's in store for the next 2? Well, let's face it, no one has a crystal ball, of course. And remember that even the president cautioned in a radio interview a few months back that his efforts on trade could create some short-term pain. But will it really be short-term pain, or is something much bigger and more sustained in the works? Naturally, there are differing opinions. Some analysts still believe the trade dispute will ultimately end with some kind of equitable agreement that helps improve the U.S. economy in the long run. Of course, as I pointed out earlier, that might not matter where the stock market's concerned if the short-term pain sparks enough fear to trigger a major sell-off and begin another, perhaps a third, wave of capitulation. Waves of capitulation are what cause each successive correction within a long-term secular bear market cycle. And it causes them to get progressively bigger. You see, big investors who'd been willing to ride previous drops all the way to the bottom finally relent and sell in the next drop in order to cut their losses. As a result, more money comes out of the market with each wave, and the ultimate drop ends up being steeper than the one before. Remember that in the current secular bear cycle, the market fell by nearly 50% in the first drop from 2000 to 2003, and then again nearly by 60% in the second drop from 2007 to 2009. Please remember also that in the months prior to each of those drops, the markets displayed patterns of nervous volatility very similar to what we're seeing now. Record levels of volatility, as we discussed earlier. But let's say the most optimistic forecast possible does indeed pan out in the next 6 months. Let's say that Wall Street weathers the trade war fears and by December gets back to the upward trajectory it was on all last year and into this January. Does that mean we're in the clear? And does it mean that 2019 will be another year of smooth sailing just like last year was? Well, again, no one has a crystal ball. But as we try to answer that question, let's please keep in mind that there are some deeply concerning facts about today's current stock market, as well as the current state of the economy, that go well beyond this issue of a possible trade war. As I already mentioned, the main fears plaguing Wall Street when the market took that 10% drop back in February were inflation and interest rates. Of course, both those could be impacted by a trade war. But even before all the rhetoric heated up over tariffs, there were issues that concerned a lot of people. As noted, the Federal Reserve approved 3 short-term interest rate hikes last year, and they've already approved 2 more this year, bringing the current Fed funds rate up to 2%. But they've taken these actions despite the fact that inflation is still just 1.9%, a little bit below the Fed's 2% target. Even more concerning, they've hiked short-term rates despite the fact that long-term interest rates are still below 3%, creating a prohibitively narrow yield curve for lending and borrowing. And as I've explained before, I believe strongly that long-term rates are going to continue hitting a strong resistance level at somewhere just below 3% or maybe just a hair over 3%. And I believe this to be true for a variety of reasons. At the same time, I also believe that inflation is going to remain low and possibly even lead to deflation. Why? Well, largely because the country's largest consumer demographic, the baby boomers, are beyond their spending years and focus more on saving money and paying off debt than they are on spending money just to stimulate the economy. I also believe Wall Street is aware of the possibility that these issues could dramatically undermine economic progress and possibly even kick off another recession. That would certainly obliterate all hope of the consistent 4% GDP growth rate that big investors were so incredibly optimistic about a year ago. Again, the markets, yes, they're forward-looking. They anticipate more than they react. All that market growth last year was based upon the anticipation of the president's tax cuts and their ability to help economic growth finally catch up to overinflated stock prices. If a majority of big investors should reach the conclusion that's not going to happen, either because of deflation or a trade war or a combination of factors, then yes, a sustained sell-off marked by waves of capitulation could very well begin. Even if it doesn't happen in the next 6 months, just keep in mind that something does have to eventually happen in order for the markets to make fundamental sense again. Until it does, I believe extreme volatility will remain the norm as big investors brace for another possible worst of times. And we're here today with the newest friend of the income generation, David Fischer. Now, David, you were talking a few times about this possible trade war and what this is going to involve, the tariffs. So let's have that conversation about how you think that's likely to affect our economy and, I guess, more importantly, in some ways for our viewers' portfolios, how it's going to affect the stock market.
Well, some people are even asking, why are we having tariffs? Some people say, we got to get this trade deficit under control between China. It's a $35 $375 billion. Some say it's not about that. It's about having a level playing field with all countries, the EU, Canada, Mexico. Some say it's just, we got to expand America, and this is how we're going to do it. But whatever the reason may be, and I think they're all listed above in President Trump's mind, tariffs are causing the global supply chain to be challenged, and in some cases might even break it. What I mean by that, let's take a stock that just got taken out of the Dow, General Electric, who trades with 20,000 companies from around the world. And they take in all these different supply chains and create a manufacturing process and send that end result product abroad. If that's relating to the automobile industry, and the tariffs go into effect of $45 billion cost would be to the automobile agency, because we sell around 200 million automobiles abroad every month. So it's quite a bit of a push down on our industry. I mean, Harley Davidson is being forced by their own admittance to now diversify and establish a presence in Europe, because that's their second largest entity that buys from Harley Davidson, which is an icon of American motorcycles. The American market has shrunk 12%. So they got to do something, either stay alive and evolve and get some of their outsourcing abroad, or die and be one of the countries, companies of the past that does this. So tariffs are throwing on, the process of steel and aluminum, throwing on a tax that gets passed off to the consumer, unfortunately. We'll see if this actually works or not, but it's causing the global supply chain to be uprooted. Next week's going to tell a lot once these big tariffs go into effect.
So, David, if it's a trade war is not if it's a zero-sum game in some ways, then I guess the question becomes, who has advantage here? Are we strong enough that we have advantage in a trade war, or do we have a disadvantage? Should we be net winners or net losers?
Depends on who you're talking to. China thinks they have the upper hand. They just lowered their rates by 0.5%, injected $750 billion into their system to support this. They're going to input 543 tariffs on our products representing soybeans, bourbon, steel, aluminum, and different other products, so that, will they sell our currency, the $1 trillion, the $1.5 trillion that they hold, that actually gets put in their place as our benefit when there is this trade deficit? So do we have the upper hand and say we need to win because the World Trade Organization hasn't been doing what they should have been done all along, and China is stealing our technology through transfers of technology? There's a lot of ifs out there. Who will win? I don't think anybody wins historically in a trade war, but we might have the upper hand because this is about the president wanting to make America great. So I don't know if this is the route that he should be going. That time will tell that.
I think the president believes there's and maybe he's the first one to have the guts to do it, but I think what's happening here is the realization that sometimes there has to be a little pain short term to have good long-term economic solutions and to make the tariffs more equal. From the stock market, my only hope is that, smart investors can now do what you said earlier on, that, let's not invest now the way we invested in the 1990s or even the early 2000s. Let's look at companies that could benefit from a trade war and stay away from those that might hurt. So, David, we need to leave it there today. Thank you very much for being on our show. It's good to have you.
Thank you, David.
And you stay with us, too. We'll be back with more here on The Income Generation. We'll be right back. So we've discussed some of the possibilities for the stock market in the second half of the year, but what about the economy? Again, it's almost necessary, unfortunately, in many ways, to discuss them separately. Why? Because there's been a fundamental disconnect between market performance and economic realities for nearly a decade now, thanks to the overuse of quantitative easing after the financial crisis, as well as its lingering effects. We already mentioned that economic momentum continued through 2017, and by some key indicators, it also has in the first half of 2018. Amid all the market volatility, job growth and consumer spending, for example, yes, have been fairly strong. The unemployment rate hit a whopping 3.9% in April, according to the Labor Department, its lowest level since the year 2000. U.S. retail sales rose in the first quarter compared to last year, and in May, the Consumer Confidence Index was at historically high levels. Now, on the other hand, as for GDP growth, it came in at only 2% for the first quarter, according to the Commerce Department, and is expected to hit perhaps 3% or so for the second quarter. And that's still a long ways away from the 4% that the president initially vowed and hoped for and campaigned upon. Now, keep in mind that his tax cuts are only starting to have an effect to improve the economy. Once their full impact is felt, we could see the growth rate increase further. Or we could see their impact diminished by the effects of a trade war, or a flattened yield curve, or creeping deflation, or some other factor, as we've already discussed. It's worth noting, though, that even the Federal Reserve has forecast a slowdown in economic growth after 2018 and is projecting GDP growth of only 1.8% for the year 2020. Because let's not forget that our massive federal debt, which according to the latest figures from the Congressional Budget Office, is projected to reach 78% of GDP by the end of this year, its highest level since 1950. And there are some other ominous details amid all the otherwise positive economic data for the first half of the year. Wage growth, for example, has lagged well behind the growth in new jobs, and consumer confidence actually fell in June, meaning Americans were less likely to say that business conditions would be better in 6 months and more likely to say that they could actually be worse. And as I already mentioned, the potential problems with inflation and long-term interest rates aren't going anywhere soon. The point is simple. If Wall Street focuses more on the ominous signs than on positive indicators like jobs and modest GDP improvement, then what happens with your stock portfolio in the next 6 months and beyond may have little to do with the relative health of the economy. Again, that's because the stock market is forward-looking. It anticipates more than it reacts. And the things that concern Wall Street aren't necessarily the same things that concern everyday investors. So, while we should all keep rooting for the economy to continue improving, of course, naturally, at the same time, it's important to make sure that you have a financial advisor who is focusing on the right details and the right priorities where your investments are concerned. We'll be right back in just a moment with our next guest, Tim Graham from the Media Research Center.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday. Welcome back. We're here with Tim Graham. He's the Director of Media Analysis at the Media Research Center. He's also the Executive Director at newsbusters.org. Tim, welcome to the show.
Thank you.
So, okay, the Media Research Center. So you have to tell me what's going on here. All this volatility is completely because the media, right? If the media stopped publishing stuff, it would stop instantly, correct?
The media would love to have that much power. I think the media would, what they want in terms of an economic response was they came out of the election saying, well, this Trump will be terrible for the economy, be terrible for the Dow Jones. And it hasn't turned out like that at all. I mean, we're up 5,000 points and we have unemployment at 3.8%. This is not what they expected. You hate to say that they're rooting for a bad economy, but hey, Bill Maher's down on HBO basically rooting for a recession. That's what they seem to want, and that's not what they're getting. And
even, it's funny because, even with the country's so divided politically and so divided with what's going on in the markets and financially, and seems unable to agree with strategy. What's the proper strategy? Why is it so bad this time? And, what would you say to people who just still, after a year and a half, just don't have faith in the president?
Well, I think it's hard for a lot of people to see the stability when you're paying a lot of attention to his Twitter account. And the media doesn't let you ignore his Twitter account. A lot of people get upset by this seeming chaos, and they need to look underneath and look at the fundamentals. And I think there is some worry out there about the tariffs and what's going to happen with trade. But again, I think people who expected that this economy was going to perform badly, we're just not seeing it. So obviously, anybody who's got mutual funds like I do, we're not making any drastic moves.
So, we might have after a few years, another book out, The Art of the Deal, for presidents of the United States. You never know. Sometimes I think that's what's going on. It's really just superior negotiation. So tell us, in the 30 seconds or so we have left, what is it then, since you own mutual funds, you're an investor, what would you tell our income generation viewers then, what the best policy is right now from investments in light of this geopolitical volatility we seem to be seeing?
Don't panic. Don't run out and spend all your money on gold. Let the economy grow. I think that the only bad thing to invest in right now is newspapers and television stations.
Yeah, and basically, don't go out and buy gold. Don't go out and buy Bitcoin. Stay the course. There's a method to the political madness, and you have to have some faith at the end of the day in the electorate. So, Tim, I'm sorry we had such a little time together today, but it was great talking with you. I'd love to have you back. We have a lot more here on The Income Generation. Stay with us. We'll be right back. I'd like to thank both of our guests for joining us for another episode of The Income Generation. I'd also like to thank you, our new and returning viewers. If you're like most people, your mindset probably starts to change once you suddenly realize that the year is half over. You look back on your New Year's goals and resolutions and realize the time for achieving the ones you fell short of or ignored is simply slipping by. If you're a regular viewer, you may recall we did a show in January all about goal setting. We talked about the importance of visualizing your goals in what I like to call a sensory-specific way, writing them down and then creating a plan to achieve those goals. Now, if you did all that and you revise your goals every day, then chances are you've made great progress and will continue doing so in the second half of this year. If not, well, pick your cliche. It's never too late. There's no time like the present. What are you waiting for? Hopefully you get the idea. But for most people, goals are financial in some way. Statistically, money is one of the major causes of stress and worry, and people strive to eliminate or at least minimize that stress and worry in their lives, and rightly so. Achieving that goal is one of the main steps toward enjoying a fearless retirement. As I explain in my book, Return on Principle, fearlessness is actually one of the 7 core values that I share to help protect your money in both good times and bad, in the best of times and in the worst of times. In other words, in all of the times in between. If you're familiar with The Tale of Two Cities, you might recall that Charles Dickens goes on to also describe the era he's writing about as the age of wisdom and the age of foolishness. And if you're a regular viewer of this show, you know most likely that I often refer to the time we're living in now as the age of economic uncertainty. In the first half of 2018, that uncertainty has ramped up even more, as evidenced now by a wildly volatile stock market. You see, no one can predict or control what's coming next, but you can control what you do or don't do right now. It's simple. If you're retired within 10 years of retirement and haven't yet made the strategic shift from portfolio growth and protection to income, as I like to say, from the G to the I, then please don't wait until a storm is heading your way to take precautions. Thanks for watching. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. We'll see you all next Sunday.